The Great Depression was the worst economic period in US history, and Warren Buffett was born in that era. He knows how grim that era was because he grew up during that time. The Great Depression lasted roughly a decade, from 1929, when the stock market crashed, to 1939, when the US started mobilising for World War II. Industrial production fell by nearly 47%, and GDP declined by 30%. Almost half of the US banks collapsed, stock shares were trading at a third of their previous value, and roughly 1/4 of the US population was unemployed. If we factor in the inflation, people who invested in 1929 had to wait until 1992 to break even, or receive at least a 0% return on their investment. That is a truly devastating scenario, if you ask me. And you know what? Buffett believes it is going to happen again. He thinks 2022 is the new 1929. Here are 3 similarities between 1929 and 2022 that have compelled Warren Buffett to make a comparison. Stick to the end of the video to find out how Americans have lost $500 billion in wealth just because of Fed's silly mistake. Similarity number 1, lack of regulation. In the early 1920s, institutional and individual investors swarmed the stock market due to the growing economy. However, many investors did not notice that many businesses were overproducing and that the stock market growth did not accurately reflect business reality because many businesses were losing money. By 1929, the stock market had become overvalued. People were able to take loans easily to buy shares and use the rising value of shares to repay their debts. This gave investors more purchasing power. Taking loans allowed them to further inflate prices when the market was up, but it also left many people in debt once the bubble burst. Joshua Luftkamüller, CFA, head of the investment strategy at Strongside Asset Management, said borrowing money from your stockbroker back then was a common occurrence, and with as little as 10% down during those times, this overconfidence also extended to industries who overproduced, which led to surpluses, which ultimately drove supply prices and share prices down. In 1929, we had one financial market that was less regulated, but now in 2022, we have a second popular financial market that is worth over $2 trillion US, which is fully unregulated, the crypto market. So we can say that similar things are happening today. Cryptocurrency regulation could be a controversial topic, but plenty of experts say crypto investors should welcome it. Some exchanges maintain compliance with growing federal and state regulators in the United States. This includes many established, high-volume US-based exchanges, like Coinbase and Gemini, but they're not regulated similarly to public stock exchanges or alternative trading systems. That can be problematic, according to Timothy Massad, a former chairman of the Commodity Futures Trading Commission and a senior fellow at the Kennedy School of Government at Harvard University. Massad said most of the trading that goes on in the crypto world today is not regulated by any federal authority, and that's a big gap. That means that investor protection is much weaker on these big exchanges than it is on our securities markets or our futures market. That's why regulation is needed to make the market safer. Crypto will still likely be a risky investment like individual stocks, but investor protections could make the market less vulnerable to outside manipulation. Which brings us to similarity number 2, artificial pumping. The late 1920s were full of notorious stock price manipulation. Much of what was considered legal at the time is now illegal. To trade stocks, investor pools were formed in 1929. The pool would buy the shares, use its media contacts to spread positive news or rumors, and then paint the tape with huge, pointless trades among themselves. This would bring attention to the stock, allowing the pool to sell the shares to an unwary public at much higher rates. The RCA pool, led by broker specialist Michael J. Meehan, was one of the most notorious manipulations of the time. Between March 8 and March 17, 1929, the pool managed to boost RCA's stock price by about 50%. The very next day, March 18, the pool sold its entire shares and divided the profits, which is roughly $100 million by today's standards. Experienced market analysts of the time, such as Roger Babson and Bernard Barak, periodically warned of the dangers of speculative market conditions. Unfortunately, few people paid attention, and the rest, as they say, is history. By the way, are you enjoying this video? Please give it a like and hit the subscribe button if you like content about business, economy, and crypto. It really helps me grow the channel. Coming back to 2022, stocks are still getting played with and markets are still getting manipulated. For several years, the precious metals business at JP Morgan Chase & Co. operated for years as a corrupt group of traders and sales staff who manipulated gold and silver markets for the benefit of the bank and its prized clients. Lucy Jennings, a prosecutor with the Justice Department's fraud section, said, "This case is about a criminal conspiracy inside one of Wall Street's largest banks. To make more money for themselves, they decided to cheat." In 2020, JP Morgan Chase & Co. admitted wrongdoing and agreed to pay more than $920 million in settlements. Meanwhile, crypto has been described as the Wild West by SEC Chair Gary Gensler due to the lack of regulation in the industry. The lack of laws and policies in this burgeoning area has created an opening for widespread fraud, scams, rug pulls, and market manipulation. Similarity 3. Missteps by the Federal Reserve. During the Great Depression and the years after, the brunt of the responsibility for the crisis was placed on the private sectors, banks irresponsibly letting their reserves get too low. This was until 1963, when economists Milton Friedman and Anna Schwartz published a study that revealed monetary policy from the Fed was largely to blame. The Fed contributed to the explosive expansion by keeping interest rates low in the early to mid-1920s. The Fed then did the exact reverse of what economists would advise today. Instead of cutting interest rates, the Fed raised them, which doubled from pre-crash levels in 1931. The goal was to discourage lending and borrowing, as well as the wild speculating that caused the market to bubble and ultimately burst. The Fed also followed then Treasury Secretary Andrew Mellon's liquidationist strategy, in which the central bank steps aside and lets troubled banks collapse. That approach ended up knocking down smaller banks, which were not necessarily bad. By 1933, 11,000 of them had failed, destroying millions of dollars in savings. Ultimately, the decrease in the money supply led to deflation. That, in turn, caused sky-high increases in real interest rates, which eliminated any possibility of companies investing or expanding. It became a period of an economic void. Now in 2022, the Federal Reserve is making gravely similar mistakes. After allowing prices to skyrocket last year, the Fed is now hell-bent on regaining control of inflation at any cost. To achieve that, the Fed began hiking interest rates in 75 basis point increments for the first time in 30 years. It also recommitted to lowering its balance sheet by $95 billion by not rolling over maturing bond assets later this fall. The chair of the Fed, Jerome Powell, has indicated that he will continue to tighten monetary policy until the inflation drops to the Fed's 2% inflation target. The Fed's overly aggressive efforts to reduce inflation are unmistakable indicators that the economy is already slowing quickly. According to the Atlanta Federal Reserve, the economy is anticipated to have declined again in the second quarter following the first quarter's negative economic growth performance. Meanwhile, 2-year Treasury bond yields have risen above 10-year yields, which over the past 50 years has been the most reliable indicator of an approaching economic recession. Other signs that we may be entering a recession are the collapse in consumer confidence, the decline of the housing market, and the strong dollar, which is lowering our export competitiveness. According to Michigan Consumer Survey, excessive inflation has pushed consumer sentiment to its lowest level in 70 years. Meanwhile, the nearly doubling of mortgage rates since the beginning of the year has reduced housing affordability to its lowest point in 30 years. This has led to a significant drop in mortgage demand. Since the beginning of the year, the equity and bond markets have lost nearly 20% of their value, while the cryptocurrency market has lost roughly 70% of its value. Meanwhile, US household wealth fell from $500 billion to $149.3 trillion in the first quarter of 2022. Historical data suggests that whenever wealth destruction like this happens, it becomes a heavy burden on the economy, and it almost always leads to a recession. Last year, the Fed allowed inflation to spiral out of control and bubbles to grow in the equity and housing markets by keeping interest rates too low for too long and flooding the market with liquidity. Fed's slow response to inflation was essentially a big mistake, and Americans have lost $500 billion in wealth because of that. This year, the Fed appears to be making the opposite blunder. By aggressively raising interest rates and withdrawing market liquidity, the Fed is bursting the asset price bubbles and fueling an inevitable firestorm of economic recession. History is repeating itself. Lack of regulation, stock manipulation, and missteps by the Fed is slowing the economy yet again. Let me know what you think about Warren Buffett's comparison of the 1929 stock market crash and 2022. Do you think the Federal Reserve can soften this blow? If you learned something new from today's video, click the subscribe button and hit the bell icon to be the first to see my next video. I make deep dives like this every week where I uncover the secrets of money and business.